Hi, I'm Bridget Cummins, Investment Advisor with Craig's Investment Partners. This year's New Zealand budget was announced earlier today, the 25th of May, and it was the most generous we have seen in years. National looks to have struck the right balance between spending more where it was necessary, yet remaining fiscally responsible. First, a quick look at how our economy is faring. The economic and fiscal forecast in the budget reflects a strong economy that is growing at a robust pace. It points to a healthy surplus of $2.9 billion in 2017 and 18, rising to $7.2 billion in 2020-21. GDP growth is forecast to increase to a peak of 3.8% in 2019, before tapering off to a still impressive 2.4% in 2021. Migration is likely to remain strong, supporting this strong growth profile. As a result, GDP per capita is forecast to be more modest at 1.8% in 2019 and slipping to 1.1% in 2021. The unemployment rate is forecast to decline to 4.3% in 2020, with inflation rising modestly over the next few years. Debt continues to fall in the forecasts, so the target of Crown debt of 20% of GDP by 2019-20 is met, while also allowing superannuation fund contributions to resume at that point. Let's take a look at what's been announced in this budget. A $2 billion family income package looks to be the centrepiece of this budget. As expected, this will see tax relief by way of changes to income brackets. The upper threshold for the lower tax rate of 10.5% increases from $14,000 to $22,000, and the threshold for the next bracket of 17.5% rises from $48,000 to $52,000. The top threshold of $70,000, where the TOPS tax rate is 33%, kicks in, is unchanged. This should ensure that the changes are perceived to be targeting low and middle income earners rather than those on higher incomes. Having said that, all earners will see benefits to some degree. Accommodation supplement payments and family tax credits will also be increased, while the independent earner tax credit is scrapped. This package commences on the 1st of April 2018. In a much needed response to the additional pressures that go with a larger population, a $7 billion boost will be delivered to public services. This includes $3.9 billion for health, $1.1 billion for education, and $1.2 billion for law and order. Capital spending on infrastructure will increase by an impressive $4 billion, well above what was forecast in last year's budget. The government's total investment in new infrastructure over the next 4 years will be $32.5 billion, which includes $9.2 billion in new state highways, as well as $2.7 billion in housing, including the Auckland Housing Program. The market reaction was very limited. Interest rates were little changed, and while the New Zealand dollar initially spiked upon release of the budget, it quickly reversed these gains. Similarly, we saw little movement in the share market in the wake of the budget, with the NZX 50 trading sideways. This lack of reaction suggests the market is comfortable with the economy, the current leadership, and our future prospects. We would not envisage any changes to our investment strategy or economic outlook as a result of anything announced today. We suspect today's budget was generous enough to keep most people happy, yet sensible enough to see the current regime maintain its image as a prudent manager of our national finances.